Welcome to Trends with Benefits, a podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. Today, I'll be speaking with Tom Lydon and Dave Nadig, two stalwarts of the ETF industry. They're a pair of financial media moguls with a couple of the greatest heads you'll see on TV. Tom Lydon is co-CEO of ETF Flows LLC, the parent company and owner of ETF Trends and ETF Database. He's also president of Global Trends Investments. And Dave Nadig, chief investment officer and director of research at ETF Trends and ETF Database, and helped design and market some of the first ETFs. But as I've learned listening to podcasts and reading about him, he's so much more than this as well. So hopefully we'll jump into some of that. This dynamic duo have recently joined forces to become guiding lights for investors and advisors, navigating the seas of the ETF ecosystem. I'll chat with them about what they are seeing in the advisory business, what advisors are looking for, and I'm sure we'll talk a little bit about ETFs as well. Gents, thanks for joining.
Thanks for having us. This is going to be fun.
Good to be here, Ed. Thanks.
So from what I've read, Tom, and I think we've talked a little bit about it too, is you started your career at Fidelity. Is that right? Is that how you started your career in finance?
Yeah, I did. I grew up in the Boston area, went to Fidelity out of school, and a couple years in, I was on the institutional support team for California. And it was funny, one of those crazy cold Boston winters, we've all experienced those. I'm out in Southern California with a client who was starting up an advisory business. And at the end of the meeting, they said, would you ever consider coming to Southern California? And I'm in my 20s, I'm single. I didn't want to go back to cold Boston. I said, yeah, I'd love to. So ended up building out an advisory firm there for 10 years. And then in 96, left and started my own. And it was great. I really enjoyed it. Custody at Schwab, had a pretty successful business going, doing, let's say, market timing with mutual funds. And it worked out well when you're buying, but not that great when you're selling, because they love to have, the fund companies love to have you in, as you remember, your old days. But when you left, they would give you a special pat on the back on the way out and say, please don't come back. And especially in the 2000s during that decline, they really hated redemptions. So at the time, ETFs were starting to make their move, and it was a great alternative. You didn't have to ask mom and dad for permission to come and go. And that was about the time that I really started to dive into ETFs.
Yeah, and then shortly thereafter, ETF Trends came out. What happened? Did you just start writing about ETFs and attracting a following?
Yeah, well, we did it with the idea to educate clients on what EFTs were all about, right?
Yeah, EFTs.
and as the more we wrote, the more people showed up. And one day, the ad agency for State Street called and said, hey, could we talk to you about advertising on your site? And one day we woke up in the publishing business. So, fast forward to today, it's been a great run, 15 years. Most recently, we've joined forces with Tom Hendrickson, who started Investopedia with a team many years ago, and their team at ETF Database. So we're now 2 years in, and it's been a great partnership. So collectively, between ETF Trends and ETF Database, we get a lot of eyeballs. And then, as you pointed out earlier, we were lucky enough to get our friend Dave Nadig on board as director of research, as most of our viewers are financial advisors, and Dave has really just helped us raise the bar there.
Yeah, fantastic. I think it's a great acquisition. Dave, I don't know where to start with you. You're kind of a Renaissance man, right? I mean,
well, I think you're overselling a little bit, Ed.
Well, wasn't there something that you worked on a production set or something, a movie set or something of that sort? That's where you got your great camera skills. And
yeah, I mean, I didn't start as a financial advisor out of college. I started as the world's worst screenwriter. And I went to Hollywood to try to do that, and that lasted about a week and a half. I was trying to write the Great American Screenplay. I think I wrote the Great American Cover Page, and then ended up just scrapping together jobs in Hollywood, and ended up as an accountant and of all things, with no experience under the age of 21. I don't know why they gave me that job, but I fell in love with the markets. I fell in love with investing through that. I learned about how money works and immediately went back to business school. And then when I was in business school, I co-founded Cerulli Associates with Kurt Cerulli and spent all of my time in, say, 90, 89, 90, 91, focused on the financial advisor market. All I did was call financial advisors, fill out surveys, try to understand how, at that time, the fee-only business was a new idea, right? The idea that you weren't going to get paid commissions was still somewhat radical in 89, 90. And really sort of grew with the advisor community as they discovered things like 401ks, as they discovered things like index funds, and sort of followed that market through. Eventually ended up at Wells Fargo Nico, helping build products for advisors that led to some of what we did with the World Equity Benchmark shares, which became iShares eventually after a couple acquisitions. Took a brief detour during the dot-com insanity and tried my hand at actually running money. Did not do that for long or well. And really realized my love was much more in this sort of interface between the innovation that goes on in the investment management world and the folks out there who have to actually consume that, whether that's mom and pop investors or increasingly some sort of intermediary, whether that's a robo-advisor or an in-person advisor or somebody who's just rolling up an ETF of ETFs, right? They're all valid approaches to using these great tools. And then came over, I spent a bunch of time with Matt Hogan and Jim Wyatt and co over at ETF.com. And then came over here to join Tom, partly because Tom comes from that advisor background. And I'm a little bit more of a wonk, right? I'm more of a quant finance, regulation, trading, blotters, that kind of stuff guy. So it's really been kind of a great marriage of different perspectives on the same problems.
Yeah. What attracted you to the Toms and this new opportunity?
It was hair care tips that really did it. But no. So, part of the thing that this merger of ETF which had been around for a decade already on its own, former Miter Media property, et cetera. I think some of us remember some of the early guys that were part of that. And then what Tom was doing at Trends, that merger brought together really this focus on the advisor in a way that I hadn't seen anybody else putting together, right? This ability to work with the advisor. We do, I don't know how many it's going to be, 100 and something webinars a year. And part of that process is actually talking to those advisors, right? We poll them, we ask them questions, they call me afterwards. And the opportunity to really be in the thick of the advisor market was just too much to pass up.
Yeah, and Ed, something to add there is, today when new ETFs hit the marketplace, they're not plain vanilla. That's not beta cap weighted strategies. In order to be different, they are a little bit more complex. And nobody but Dave can get out there and make something complex really simple in the eyes of the advisors. So it's really been great having him on the team and also being able to hand over half of the webcasts every year for me.
Oh, that's it. That's really why you hired me. I understand now.
I can imagine. Yeah, Tom, you were doing a lot of them when we did a few more with you. Seems like you were just doing one every day. I don't know, was it one an hour?
Yeah. Well, the great thing is Dave says you learn a lot because you get the interaction with the advisors. And now taking it a step further, we can actually track the behavior of advisors that come to our sites. So they actually show us what they're looking for. So for example, if they're looking for more alternative strategies today than they were a year ago, our writers are actually writing more about it. And we're actually being able to give feedback to the ETF issuers that, hey, guess what? Advisors are looking more at these types of ETFs than these types of ETFs, which has really helped to a degree with giving advisors what they want, but also helping issuers focus on what advisors want as well.
Yeah, so I want to come back and talk about that. But in terms of the combination of ETF Trends and ETF Database and going forward, what's the mission? What are you guys looking to accomplish, in the next several years?
So the big thing right now, Ed, is especially in COVID has been a great example. You look at the average advisor and what they've been through this last year and the way they've had to deal with the health scare, work from home, have their employees work from home, and then maintain a high level of research while also maintaining a high level of communication with their clients. It's been a lot. But it worked right into our wheelhouse because everything's online. The more that we can do, the better. And it's not just the written content online, but it's also the webcasts, the virtual conferences, the video. Dave and I are doing a heck of a lot more videos and podcasts now. And as you know, from being with a distributor of mutual funds and ETFs, it's difficult to have traditional distribution because your wholesalers, your independents can't necessarily get out there and work directly with those advisors. You can't necessarily get them on the phone, but you understand the value of content, and all the ETF issuers are up in their game. But we have such high Google search rankings that rather than put it on their own sites, if there's something that we can do and take the essence of their research, put it in our content in a variety of different ways, we can actually reach more advisors.
Yeah, and I'd sort of extend that. I think one of the cool things about ETFs over the years has been they've always been at the front end of disruption, right? I mean, you pick a financial argument since 1993, and ETFs have been right in the middle of it, from temper tantrums to rational exuberance to everything in between, right? So wherever there is change, you'll find the ETF structure in the ETF industry. And Tom's highlighting what is, I think, probably the biggest change I've ever seen in the advisor business, which is that move towards digital. And when we talk to advisors, and we just completed a huge survey on this, they're not going back. Like, for most advisors, this has been a net uptick in the quality of the relationships with their clients, in terms of the quality of their portfolios. They're getting more time to do good research, and they're getting more time to talk to their clients because they're not sitting there listening to a wholesaler take them to lunch, because they're not getting in the car to drive to their client's office, because they're not getting in the car to go to the golf course to spend 4 hours with the client, where, half an hour of that is sort of really genuine interaction, and the rest playing a lot of golf, right? So all of those things came off the table with the pandemic and sort of the economic rebuilding that we're doing here. And what came on the table was relationships and time, and that's been super valuable.
You mentioned the poll. Let's talk a little bit about that. You guys recently, I guess, polled advisors, kind of dealing with the COVID situation. I think, Tom, maybe you had some of the insights on that. Could you share kind of what you learned?
Oh, absolutely, Ed. And so we surveyed almost 2,000 advisors about how they were adapting to this work from home environment. The good thing is they scored themselves very, very well. I mean, they were well positioned where they gave themselves high marks across the board as far as communication and productivity, all very, very, very excellent. 64% of advisors said the relationship strength had actually been just as strong, where 18%, almost 20%, almost 1 in 5 advisors said that through technology, they increased the value of the relationship with their clients. So that was really, really good. The other thing that was very interesting in advisors, I mean, we're all a bunch of weirdos for sure. We have big egos. Our opinions mean a lot. Ask us about the market, we're going to tell you about it. When we ask them about their technology knowledge, they all scored themselves very, very well. But the funny thing is, what they did is we asked them, how was your knowledge going into COVID? And then now today at the end of the year, how knowledgeable and is your knowledge increased as far as technology? 45% said their knowledge on technology increased. So everybody stepped up in a big, big way. And on top of that, I think the one thing was, even though they said they were prepared for it, they said they put a lot of hardware and software investments into not only for them themselves, but their employees too. So they've upped their game. And finally, the big thing is they're not going back. Where a good percentage of advisors pre-COVID felt, no, you had to be in the office, the vast majority of advisors are going to have some form of work from home policies going forward, even after we're past COVID, which bodes really well for the advisor community because they've adapted to technology in a big, big way. And their clients are going to be more accustomed to being able to have, video meetings and conferencing, which is going to make everybody more productive.
That should hopefully lower their costs as well, right?
Yeah, it's definitely going to lower their cost. That's a huge part of it, is the cost reduction. And I think it's important to point out, this is a community that is not known for changing quickly and adopting new things super quickly, right? I mean, that's been one of the challenges of being an issuer. I'm sure you know, Ed, like trying to sell into that market, is this is a fairly old market. I think the average age of a financial advisor is mid-50s or up. It's a very homogenous market. It's overwhelmingly male. I think it's about 80-20, which is certainly not the population split. So this is not a market that you would have thought was going to be an early adopter, that was going to move quickly and change their models. I mean, look how long it's taken just to get things like, fee for service as opposed to commissions through the brokerage community, lightning speed at 25 years and counting. So it's definitely the case. This is not a quick moving market. And yet, when challenged and put in this crisis situation, they absolutely responded. And if anything, I think they've led the rest of the market. All right. I don't think when you ask the broad S&P 500 sector, how many of you are changing and implementing new work from home policies, it isn't all of them, for sure.
I think it's been probably really great for them just to be able to touch with their clients and touch base with them more easily. You don't have to make an appointment necessarily to come in and spend that whole time in office or what have you, but I feel like it's a real easy way for them to have made that connection and show that they're adding value and stay in touch. Did you get any sense in your polls or talking with other advisors that there's a bit of Zoom fatigue?
Well, I think we all kind of see that to a great degree. Again, all day long when we're doing meetings and it's on video, you got to pay attention. And I think we've all also been on those calls where people just tend to bug out. Maybe they're eating a sandwich, or they're still in their pajamas or something like that, right? But to a great degree, when it comes to dealing with your clients, I think they've really stepped up in a big way, and we've asked them going forward. It's really going to be something that they're going to continue to insist on. Not just one-on-one meetings, but a lot more doing not only group meetings, but also videos that they can package and send out to their clients as well. So that's so much more efficient, where you can get that message down. How are you looking at the market this quarter? Where are the opportunities? Where are we going to, what is that going to mean to your portfolio? Where they weren't thinking about doing that before. It was all the in-person meetings at a client's home or at your office.
Outside of Zoom, have you guys come across any interesting software packages that advisors have picked up that have been really helpful that others might want to know about?
Well, there's definitely a lot of movement in the sort of advisor tech space, right? I mean, there's hundreds of companies. I know Michael Kitces keeps track of a giant board of like all the logos of all of the advisor tech companies out there. And this definitely, I've heard from many RIAs, this has been a time when they've been evaluating everything from who is their core custodian, which is obviously a much bigger decision, to, am I going to use Orion? Am I going to use, Riskalyze? Am I going to, a lot of change happened in this year, precisely because of what Tom was saying, because they're sitting at their desks interfacing with technology all day, every day. To your point, Ed, yeah, there's some fatigue on some of this, but what I think we're starting to learn is video like this, or a Zoom call with a client, or doing a webinar, they all have a purpose, right? They all have a thing that they're very good at doing. And I think early in the pandemic, say March, April, May, when we were all sort of trying to figure out how do we still do our jobs, there was this sense of, well, everything we're going to do is going to get 50 people on a Zoom call. We're going to do these things after hours. We're going to do them on the weekends. We're going to do them during the market, after the market, before. And I think that there was a lot of fatigue on that. We made our own tilts at that windmill as well. And I think what we're learning is, horses for courses, right? Different technologies, different formats work for different purposes.
Let's go back to your site. Dave, I don't know if this is something that you can talk to in terms of what you're seeing in terms of advisor behavior on the ETF Trends site. Where are they going? What are they interested in? What kind of activities do you see?
So, throughout 2020, what I was trying to do is sort of grab themes, right? Where advisor focus is going, and then try to follow the flows after that, right? Because there's a narrative you could tell about, well, they research it first and then they buy it. Unsurprisingly, but satisfyingly, that is the case. You can sort of watch the traffic, you can watch where advisor focus is, and then, some period of time, assuming that the fundamental investment thesis holds out, you see the flows follow into that, which has been really exciting to watch. Throughout 2020, the four big ones, and I don't think these are going to come as a surprise to anyone, the hunt for income. Obviously, advisors are just desperate to replace their bond letters with almost anything. Risk management, I think that's going to be a topic that's very front and center still in this first quarter, but a lot of concern even before the March drawdowns about how am I positioned for a potential drawdown? Am I diversified enough? Do I have a hedge strategy in place somewhere? That I think, again, will continue to be something important. ESG, this is a big, huge year for ESG. It's going to be another big, huge year for ESG. And then a category that I'll just call anything but beta, whether you talk about active management, non-transparent active, thematic funds, smart beta, put a big bow on all that stuff. It's all non-beta, and it all had a really good year. And we see continued strong interest from advisors on funds that sort of fit in that ABB bucket. The two new trends that we're seeing much more than we were, say, even in December or November, are really just around the two, again, maybe seeming obvious in hindsight. Infrastructure, we've seen a pickup there for really since November before the election was when we started to see more interest. The connection there, obviously, to the Biden administration and the plan they put forth last night on TV, that's, I think, really a fairly obvious thing. Not an obvious investment. Investing in infrastructure with big air quotes around it is not the same as saying you're going to go find cloud computing companies, right? Because one person's infrastructure is another person's utility. And that can really lead to some portfolio problems or challenges. And then the last one is inflation. I'm not a big believer that we're headed for headline inflation in the next 18 months to 2-year window, but that doesn't mean a lot of people aren't. And they're looking at whether it's tips, whether they're looking at counter-cyclical opportunities and inflation-sensitive stocks. There's all sorts of opportunities there. Personally, I believe we need to see money velocity increase, but I know now we're deep in an academic wonk conversation.
I agree with you on the velocity part.
Dave, you did that whole thing without talking about Kathy
I
Wood.
mentioned anything but beta. Yeah, I mean, that clearly the ARC phenomenon and Kathy Wood's success, which are nothing but success. I think the team there is phenomenal. And they've caught lightning in a bottle. We'll see how long they can shake it and keep the lightning going. That's always a problem when you have these super outperforming years. I don't think even Kathy would say she thinks she's going to get 150% a year for any number of years together.
Yeah, do you have a sense that people are opening up to active again and open to that possibility and the potential of active?
Yeah, and the crazy thing is after being at Fidelity, and I was there when Peter Lynch was hot, and there were rock star fund managers. The ETF industry is so boring. We didn't have any rock stars, right? But Kathy kind of is a rock star, right? And it's nice to be able to put some personalities behind some of these ETFs, especially when they have so much conviction. I'm not sure if you guys caught the recent Balchunas Trillions podcast, where they had Scott Social, who was the portfolio manager of the Janus 20 fund from like 1997 to 2007. And back then, he was clearly a rock star.
Yeah.
High conviction, very active. The cool thing is, although during the 2000 2002 decline, NASDAQ went down 70%, they were only down 30%. And he was kind of comparing her conviction today to what they had then. And they really did pick great stocks. And I think going forward, the idea will be, will more of these active strategies really be able to show that alpha? And when we do get a correction, are they not going to give back as much? Will their shareholders stick with them during that period of time? And then what can the managers do from a connectivity standpoint to keep them in there through those bumpy periods?
Yeah, good point. I kind of also sense that investors like to have a star manager. They like to know somebody's trying to pick the best stocks for them.
Yeah, I mean, that's key to the sort of anything but beta theme here. And to ARC's credit, I think there's something we can all learn from how they've managed this process. Put aside for a minute whether you believe in their picks or not, or you want to be an investor. If you just look at them as a business, they've made such a phenomenal commitment to not just transparency, but education. So when they make a move in a stock, it doesn't just show up on the trade blotter. You can go see their justifications for that position. You can read whole documents that they put together about why they're in a particular sector, what the forces are affecting that. They produce podcasts about it. They produce interviews with individual companies. They do the videos. The amount of content that's produced out of that shop is absolutely astonishing. And I think that's part of the allure here is you're not just investing in a fund, you're investing in a process and a team, and that team tells you what they're doing every single day. So it's almost a little voyeuristic. And I think that that's not unhealthy. Tom, to your point, when you see the pullback, the big issue is always the folks who got in last, right? The people who bought in after the fund's up 150%. Well, if the fund has a 25% pullback from that level, that's amazing performance if the market's down 50%. But if you got in at the top, it still feels pretty awful.
On previous episodes of this podcast, I've done a trend or fad question about ESG, and it's kind of jokingly, is ESG being used as kind of in a faddish way? It's good. It's great that everybody's considering these kind of factors, but just the very rules-based formulaic approach maybe wasn't the right approach all the time. Do you see ESG maybe morphing into something else, whether it's just simply sustainability or something outside of ESG?
I don't think we're going to get rid of the acronym, unfortunately, just like I don't think we're going to put smart beta to bed anytime soon. I think we're stuck with the acronym. It is a challenge like smart beta in that no two people even agree what the heck it means. And people weight things very differently, right? I mean, the LGBT funds and the Catholic values funds sit in the same research bucket. And obviously those are catering to very different audiences. So it is a challenge to think of ESG as a theme because it means different things to so many people. I think what we'll start seeing is firms and advisory firms focus on the thing that they believe in most or that they can get behind most. So for instance, if you go to an advisory firm like Sage down in Texas, right, they've been very focused on why, say, green fixed income exposure is going to be better fixed income exposure. Not just that you should feel better about it, but that you're going to get superior risk-adjusted returns if you really take this stuff into account. So that's a particular angle that they're taking. They're selecting bonds and ETFs based on that belief system. Another advisor somewhere else may have a completely values-based approach to this. They're going to be in a very different set of stocks or a very different set of ETFs. I think it's permanently part of our discussion space, but I don't think it's going to be one size fits all.
So I need to ask you about something. I'm going to open up the shop a little bit to some internal discussions for you here. And since we're talking about ESG, I'm going to ask you about the importance of ticker symbols generally and about one of our ETFs in particular. So we have an ETF, SMOG is the ticker symbol, SMOG, our low carbon energy ETF. Well, some folks internally hate that ticker and they don't know if it's, thinking that perhaps maybe clients, advisory clients don't like to see that on their statement when they're trying to actually go against SMOG. But what's your take on the importance of a ticker and perhaps something like that? Is it a bad ticker? Is it memorable and therefore it's good? Should we change the ticker?
Yeah, I don't think you change the ticker. Just the fact that we're talking about it, it means it's a good ticker, Ed, right?
That's what I said.
I mean, that's the thing. It's a good ticker. People are talking about it. It's great. And it's so funny how people will try to overthink things sometime. We were doing a webcast yesterday and there was like a hedge equity component. So they had HE in there and then they tried to put their name in there. No one could figure that out except
Right.
them because it meant something to them, right? But when you get a ticker like JETS, you know what you're
Right.
getting,
Yeah.
right? So I think those are the types of things we have to think about for sure. And there's a lot of creativity and people are embracing it. Others, I think, sometimes overthink it. I don't know, Dave, what's your thought?
Yeah, I mean, you can only do so much with 3 and or 4 letters, right? I mean, it's a pretty small world that we get to fish out of. To try to convey an entire investment strategy in 3 characters or less is taking Twitter to a new extreme. Memorability does matter, and memorability has mattered in the ETF space, honestly, since the Qs launched. Right, as soon as that came out and people were like, "What, the Q, huh?" they invested like crazy in saying, no, the NASDAQ 100 is the Qs. And they labeled the Qs and they pushed that out there. And they caused chaos when they added a fourth Q to that thing. And then they added chaos again when they changed it. So I'm not an advocate of changing a ticker. Definitely not an advocate of changing a ticker that has some sort of mnemonic component to it. I mean, you guys have done this for years with ANGL for Angel. And I mean, it wasn't Moo. Moo is yours too, right? Like one of the greatest tickers of all time.
Yeah, Moo's Van Eck one, yeah.
Yeah.
But
yeah.
I didn't come up with that one.
It's almost like Dave and I joke about all the time about all the ETF related URLs that we've saved that we're never going to do anything with. And we think maybe somebody's going to buy one. It's not going to happen. But with the exchanges, we know when we talk about them, how many are reserved. And, you guys are probably in the hunt there. You probably got a bunch of ideas and you call the NYSE and you go, hey, will you reserve this? But a lot of them are already grabbed up. So some of the best are already grabbed, right?
Yeah. I'm waiting for that fifth digit so we can have more words.
Oh God, no, I can't. Then I'm never going to be able to tell them apart from mutual funds, and I'm doomed. Don't do that to me. I used to know all the tickers of all the ETFs. That ship sailed.
When the first crypto ETF comes out, what's going to be the best ticker there?
Oh, geez. Well, HODL, right?
Yeah.
HODL. That's got to be it.
HODL. Yeah, HODL.
Isn't that something already?
It probably is. Like I said, I used to know all the tickers. I don't know anymore.
Something else I want to get your opinion on, just because I recently had a discussion about this with a couple different folks, and we were talking about active, and of course, Kathy Wood and ARK has been very successful. Love what they're doing because they are very transparent as well. But we have a lot of the old school traditional mutual fund shops coming into the ETF space. Do you think that they will be successful because of their large distribution force and relationships that they have? Or do you think it'll be harder than many people think because their sales force is not used to selling ETFs and perhaps more used to selling against ETFs?
I do think that most of these folks are going to have what we would have 3 or 4 years ago considered, at least mid-level success, right? I mean, if you look at, say, T. Rowe and American Century and Fidelity jumping in with their active products, transparent or non-transparent, I don't think the market cares all that much, honestly. But you look at what they've done, and we're not talking about them a lot. Like, we're not talking about ACI and T. Rowe like we're talking about ARK. But then again, they didn't have a fund that went up 170%. But they're also pulling in hundreds of millions of dollars. And we used to think of that as being very successful ETF launches, right? You launch something in March and end of the year, you've got like $500 million. People are popping champagne bottles. Now we're sort of like, well, but they didn't beat ARK. I mean, come on. So I think they're going to be successful. Obviously, they're leaning into their existing relationships. And most of these firms, when you talk to the product management folks, not the marketing folks, the product management folks, they will admit this is demand driven. They have clients that want these strategies. They're in these strategies, and they want the liquidity and the tax advantage they get by putting it in an ETF wrapper. It's just that simple. Now, I don't think that means that that these are going to go away, like the mutual fund side. I think most of these strategies are going to show up as clones, and those clones are going to sit there on the mutual fund side because there's not a good path to take them out of 401k plans, and most traditional active equity funds are in a 401k plan somewhere.
Yeah, and Dave hit the nail on the head. It's demand driven. Their current clients are saying, hey, love your manager, love your style. It's better in an ETF wrapper for me for a variety of different reasons. So they're jumping on board. Are they late to the party? They are. But if they do it the right way, a couple things will happen. Number one, in marketing these ETFs for the first time, you can actually do a brand bump that can help your overall company. And some companies are doing a pretty good job doing that. T. Rowe Price is doing a great job. American Century is doing a great job. It's going to be interesting when we see Capital Group come out. How are they going to have a very, staid type logo and tradition to jazz it up a little bit? And is it just going to be for their ETF offering, or will it be for the whole company? I think that'll be important. But Ed, back to your point about distribution, they have embraced traditional distribution. Are they going to understand that financial advisors today, especially those that are ETF centric, tend to want to get things through Google search first, and then they'll dive in and do their own research, and maybe will never want to talk to a wholesaler or an internal. But want to make sure that they can get all the information they need about that ETF. That's frustrating for a traditional sales force. And internally, there's going to be some strife about how do we pay for the distribution that might come from actually not having a conversation with that client.
Mm-hmm. Yeah, I just know from our experience, having both mutual funds and ETFs back several years now, just trying to find that right balance of incentivizing a wholesaler team the right way and making sure you got good coverage for ETFs and mutual funds. But there's better data out there now. And yeah, we'll see how that all plays out. I think you guys make some great points. Kind of turning the tables a little bit, are there certain topics or things investors should be paying more attention to, specific asset classes, regulations that are top of mind?
We talked a little bit about crypto, just joking around. So again, there's demand there. We also just finished another survey among advisors with Matt Hogan over at Bitwise. And this is the third year that we've done it. And it's crazy how the interest and adoption among the advisor community for crypto is going through the roof. Personally, 24% of advisors actually own crypto personally. And it's interesting regarding their clients. 28% of their clients do not own crypto. 34% say some of them own crypto. But the crazy thing is 38% of advisors' clients, they don't know whether they own crypto or not. So there's kind of a neat opportunity here for the average advisor. Talk about it, even though you may not have a solution for your clients today because everybody's waiting for the ETF to come out and they don't want to buy a product that has 100% premium. There are some other options. And if you don't talk about it, your clients are going to go rogue. They're going to go off and get a Coinbase account. They're going to do something themselves. So eventually this is coming. You can't start soon enough by asking them about their interests, talking about it, and trying to develop some type of strategy, even if it's off platform.
Right. And if you think about it, there are advisors out there who have had specialties in what I would call non-custodial assets, right? I know a couple of advisors that are really into helping their clients build passive income real estate portfolios, right? That has nothing to do with whether or not they're getting a statement from Schwab or TD or Fidelity, right? Or Pershing or LPL or anything like that. They've built a practice around this unique alternative investment stream. And I think that's the phrase. This is alternative investing streams. Bitcoin's part of that. We'd love to see it in an ETF wrapper. There are all sorts of other alternative streams out there that investors should be focused on, advisors should be focused on. Some of them have done really well, like managed futures has been in the doghouse for a long time. I just took a look at like DBMF, which is a recently launched managed futures fund. It crushed it last year. Nobody seems to care. That's a mistake. There's a lot of this product coming out in the market. A lot of it's quite good. Most of it's based on institutional caliber research. And these are important diversifiers, particularly if we're thinking about the next couple of years, right? Super low interest rate environment, increased volatility from retail traders. All signs point to coming up with something that gives you something that is different, that gives you a counter-correlated return stream somewhere. So whether it's Bitcoin, whether it's managed futures, whether it's real estate or Rally Road and buying parts of cars, whether it's Masterpiece and buying part of a Banksy, all of these things are actually really important as we start thinking out the next couple of years.
Did you guys hear that yesterday a Mickey Mantle rookie card went for $5.2 million?
Really?
5.2 million.
Holy
Yeah,
cow, missed
crazy.
that.
So I've got a Mickey Mantle rookie card. I think it's got some gum stuck in it, but it's. I'm really excited.
How do you get that off? More gum and just try to rip it off?
Yeah, I don't know. No, well, it's funny, and I'm happy to go off on a tangent, but I think collectibles, as Dave was mentioning, Rally Road, Masterworks, where you can buy a piece of something, that's great. But card collecting has just gone through the roof in COVID because it's something that you can do, while you have time at home, something you can do online. They have online auctions available. I use this place called Invaluable. My wife's about to kill me because all these little packages.
Oh, I was going to say because of the bank statement.
Oh, yeah. Yeah. But I'm having fun with one of my sons on it. And I think as an alternative investment, there's something to it. And all joking aside, I do have a Mickey Mantle rookie. It's not in that bad a shape, but actually today there's so much good data about current sales that are going on, and it's a little bit of fun too. So we need a collectibles ETF, Ed. Can you put that on the list?
Yeah, that idea's been thrown around. Yeah, we got to figure out the right way to do that.
I'm sure there's a SPAC answer for it.
Yeah, I know. Tokenization is coming, I think, at some point, but
well, that's another tangent. You want another 3 hours on tokenizing the ETF industry?
We'll bring you back for that. All right. So each of you get to answer this question. What is one long-term trend you see playing out over the next year or several years?
Well, so I think that we are still moving towards a wrapperless future. I'm a bit of an outlier on that. I've been talking about direct indexing now for 4 years. It's starting to catch some traction. There's a bunch of really critical acquisitions happened over the last 16 months or so. Parametric being bought by Eaton Vance, probably being the most notable, but the sort of the detritus, the leftovers of the motif investing platform ending up at Schwab, along with their very, very, very smart people, points directly towards this idea that eventually we're going to be going into our Schwab account, and instead of buying SPY to get our S&P 500 exposure, we're simply going to check a box that says, yes, I would like 15% of my portfolio in the S&P 500. And then under the hood, they're going to do a fractional share portfolio, which is just mine. That's coming. It's really hitting the advisor market first, and I think that's a good thing. O'Shaughnessy Asset Management's Canvas platform has been getting a lot of play lately around their custom indexing solutions. So I think it's all very good, and I think it's positive for investors and advisors. And over the next year or two, I can see that starting to trickle into sort of more mainstream discussion. I don't think ETFs are going away anytime soon. All of these initial forays are going to be very much in the sort of, cap beta space minus some exclusions. Like I want to be in the S&P minus Google, or I want to be in the broad market minus gun stocks. Very simple things like that. So Ed, I wouldn't be worried too much about your franchise. You guys are focused really on areas of the market that are difficult for most investors to think about, much less invest in. So I don't think those are going to be direct indexed out of existence, but it's a trend that I think is inexorable because it removes more and more friction from the process of investing.
I think back to asset allocation, when you think about the traditional 60-40, it's challenged. I mean, we've talked about this in the past, but it really is challenged today. I mean, the fixed income side, the 40, it's really tough to get yield. And as we're starting to see rates kick up a little bit here, trying to find alternative income strategies is going to be difficult. I think the big thing here is alternative investing is going to become more and more popular. Dave touched on fixed income, things like options overlay strategies. We really like what's going on over at Nationwide with their Newsy product. It's tied to the NASDAQ 100, but kicking off almost an 8% yield. If there are areas where you can be alternative and non-correlated while also kicking off a yield, that would be great. Areas like natural resources, Ed, and you guys are all over that. You're seeing prices tick up, but people aren't talking enough about it right now. And they're real easy strategies that can help out there. I mean, think about the demand for lithium with Tesla going through the roof. We don't have a handle on that yet. And there are people that do. So those are going to be areas to think about. And then with all joking aside, back to card collecting and Masterworks, I think that there are going to be other collectibles, whether it be, and here's my feeling on it. We have a segment of the population that actually is really, really hurting right now. And they have to generate money. They're not going to depend on the government alone. And some people are sitting on art. Some people are sitting on old cars. Some people are sitting on baseball cards that are worth a lot of money. That stuff's all kind of coming out into the marketplace. People are taking advantage of that. And fortunately, these folks have those things available to be able to sell. So you're starting to see an uptick in that. So alternatives is something that we as a company are going to spend a lot more time on in the coming years too.
All right. So now we have our last segment. It's called Trend or Fad. I'll throw out a few different concepts and you guys let me know if you think it's a trend or fad. Finance TikTok, trend or fad?
Fad.
The term disruption, trend or fad?
Oh, God. I mean, how can it be a fad if we've been overusing it for 30 years?
I know. Okay.
Disruption TikTok.
There you go.
There you go.
Trend or fad?
Retail investors, trend or fad?
Trend.
Yeah, totally agree.
Sports betting, trend or fad?
That's a trend.
Yeah.
I mean, it's going to start opening up. Davey is doing a great job. So Davey's, he's got Pennsylvania, but he's opening up in Michigan.
Yeah. I mean, I think it's probably a trend. I think it's here to stay. I think, the idea of gaming, gambling, whatever we want to call it, being disintermediated and going out into the internet, that's sort of inevitable. I mean, that's what's happened with poker. It's what's happened with gaming, like video games. Like, I think that's just sort of inevitable.
Guys, thank you so much for being on Trends with Benefits. Definitely go to etftrends.com. How about some Twitter handles, Dave?
Yeah, we're easy. At Dave Nadig, at Tom Lydon.
Look forward to seeing you hopefully in person sometime in 2021. Other than that, I hope you have a very successful 2021. And for those listening and watching, thanks for tuning in to another episode of Trends with Benefits.